Right now, something unusual is happening in the global markets. The S&P 500 is trading around 5,000 points. The Nasdaq is hovering near 17,600. Dow Jones sits close to 38,500. Gold is trading near $2,030 per ounce. Silver around $23.50 per ounce. Bitcoin above $51,000. US 10-year Treasury yield near 4.2%. Global stock market value over $105 trillion. Global debt over $315 trillion. And yet, despite all these numbers rising, silver is falling behind. But history says when silver behaves like this, something big happens next. A massive move, a sudden crash, or an explosive breakout. And today, we will uncover what big banks, institutions, and market insiders are quietly preparing for. Because the truth is, silver may be heading toward its biggest shock in decades, and most investors are completely unprepared. The strange gap between gold and silver. Let's start with the numbers. Gold is up nearly 18% in the last 12 months. Silver? Only about 9% growth. Gold demand increased by roughly 7% globally. Silver industrial demand rose by more than 12%. Yet prices do not reflect this demand. Why? Because something called the gold-silver ratio is flashing a warning. Right now, the gold-silver ratio is around 86 to 1. That means it takes 86 ounces of silver to buy 1 ounce of gold. Historically, the average ratio is between 40 and 60. Whenever the ratio moves above 80, markets usually experience major corrections or explosive price movements. In 2008, the ratio crossed 80 before financial markets collapsed. In 2020, it reached 120 before silver surged 150% in months. And now, we are again above 85. That is not normal. That is a signal. Silver supply versus demand crisis. Now look at supply. Global silver production is roughly 820 million ounces per year, but total demand has crossed 1.1 billion ounces. That's a deficit of nearly 280 million ounces, a supply shortage of more than 25%. Industrial demand alone consumes over 55% of global silver supply. Solar panels use nearly 140 million ounces annually. Electric vehicles demand growing at 15% yearly. Semiconductors using record amounts. Green energy transition accelerating at 20% growth rate. Demand rising, supply falling. Prices should rise. But instead, price suppression is being discussed by many analysts. Why would prices stay low despite shortages? The paper-silver problem. Here's where things get interesting. For every 1 ounce of physical silver available, more than 250 ounces exist on paper markets. That's futures contracts, derivatives, leveraged positions. In COMEX exchanges alone, paper silver trading volume exceeds physical supply by over 400 times daily. This creates artificial price pressure. Banks can sell massive contracts without owning real silver. If even 5% of investors demanded physical delivery, supply would collapse. That is the risk. That is the hidden instability. And big banks know this. Big banks, positioning data. Now let's talk about positioning. Major institutional traders currently hold massive short positions in silver. Some estimates suggest top 4 banks control nearly 40% of silver short exposure. Meanwhile, central banks worldwide are buying gold aggressively. Global central bank gold purchases crossed 1,100 tons in 1 year, the highest in history. But they are not buying silver. Why? Because gold stabilizes currencies. Silver destabilizes markets. Silver moves faster. Silver is more volatile. Silver exposes financial weakness. If silver suddenly rises 200%, it signals currency instability. That is why silver volatility is closely monitored. Inflation pressure and monetary expansion. Global money supply has expanded massively. Since 2020, central banks injected over $12 trillion into the economy. U.S. Federal Reserve balance sheet grew from $4 trillion to $9 trillion. Money supply increased over 40% in just 2 years. Historically, when money supply expands, gold rises first. Silver follows later, but much faster. In the 1970s inflation crisis, gold rose 2,300%. Silver rose over 3,800%. Silver always moves more aggressively. But currently, silver is not reacting fully. That means either silver is suppressed or silver is preparing for a violent move. Industrial demand explosion silver is not just a precious metal. It is an industrial necessity. Solar industry growth rate, 25% per year. Electric vehicle production expected to rise 300% by 2030. AI chips and electronics demand increasing 18% annually. Each solar panel requires silver. Each EV uses silver. Each smartphone uses silver. Global technology transition depends on silver. Yet mining growth is only 2% annually. This creates long-term imbalance. Mining supply constraints. Silver mining costs are rising. Average production cost increased from $12 per ounce to nearly $19 per ounce. Energy costs up 35%. Labor costs rising 20%. Ore quality declining globally. New mine discoveries at lowest level in 30 years. Less supply, higher costs, lower reserves. But prices not reflecting reality. That is not sustainable. The debt crisis connection. Now connect this with global debt. World debt exceeds $315 trillion. U.S. national debt above $34 trillion. Interest payments alone exceeding $1 trillion yearly. Debt grows faster than economic growth. Historically, such conditions lead to currency devaluation. When currencies weaken, precious metals rise. Gold protects wealth, silver multiplies gains. But before major moves, markets often experience panic crashes. Is a silver crash possible? Yes. And here's how. If global recession hits, industrial demand for silver could temporarily drop. Factories slow, solar installations decline, manufacturing decreases, short-term demand falls 15 to 20%. This could push silver price down to $18 to $20 range, a crash of nearly 20 to 30%. But historically, such crashes are followed by explosive rallies. 2008 crash, silver rose 400%. 2020 crash, silver doubled in months. Crash creates opportunity. Or is a massive surge coming? If physical shortage becomes visible, if investors demand delivery, if inflation rises again, silver could jump rapidly. Many analysts project $30 per ounce short term, $50 during supply shock, $100 possible during currency crisis. That would be a 300 to 400% move. Silver is a small market. Total silver market value roughly $1.5 trillion. Gold market value over $15 trillion. A small shift of capital causes huge price change. The global economic trigger. Several triggers could ignite silver movement. U.S. interest rate cuts, dollar weakness, banking crisis, energy shock, geopolitical conflict, currency reset discussions. Each increases safe haven demand. Gold reacts first, silver follows aggressively. Investment flow data. Institutional funds currently allocate less than 0.5% portfolio to silver, around 2% to gold. If silver allocation rises to even 2%, trillions of dollars could flow into a tiny market. Prices would skyrocket. Supply cannot match demand quickly. Historical performance comparison. Let's compare performance. From 2000 to 2011, gold rose 600%. Silver rose 1100%. From 2008 crash low, gold gained 170%. Silver gained 400%. Silver is always more volatile, more risky, more explosive. Why big banks stay silent. Big banks prefer stable markets. Silver volatility creates financial instability. Large price spikes expose currency weakness. Rising silver signals inflation failure. Therefore, market stability requires controlled movement. This is why large institutions manage exposure carefully. The hidden risk most investors ignore. Retail investors own very little physical silver. Most investments are paper ETFs. But if trust in financial system weakens, physical demand could surge. Supply shortage would emerge quickly. Prices could disconnect from paper markets. What should investors watch? Watch these numbers carefully. Gold-silver ratio above 80, volatility coming. U.S. dollar index movement, interest rates direction, industrial demand growth percentage, Physical silver delivery data. Mining production numbers. Each indicates future price direction. The next 12 months prediction based on current data. Silver volatility expected between $18 and $35 range. Possible crash risk, 20%. Breakout probability, 60%. Stagnation probability, 20%. Risk high, opportunity higher. Final reality check silver is not just a metal. It is a signal of inflation, a signal of currency strength, a signal of global economic stability. Whenever silver moves violently, something deeper is happening in the financial system. Right now, demand rising, supply shrinking, debt increasing, money printing continuing, ratio flashing warning, volatility building. The system is under pressure, and silver may reveal the truth first. Final message. The question is not whether silver will move. The question is how violently. A crash, a surge, or both, because history shows silver falls fast, but rises faster. And when the next move begins, it will not give warning. It will happen suddenly. And those who understand the numbers today will understand the future tomorrow.